So we've got all the news and information around the World Bank IMF 2019 spring meetings last week. This one is about the headwinds of likely global economic recession coming through in 2 to 3 years. Some are forecasting the U.S. economy will go into recession between 2019 and sometime in 2020. All of that still on the straight. So the spring meetings brought all of that into the fore. Then you talk about the global financial stability with warnings to central bankers and fiscal policymakers to keep their eyes on the ball. So let's put all of this together. And what is in it for Nigeria as a frontier market? Uchenna Minis is joining us. Is the chief market analyst at Eagle Global Markets. Is live to us from our studios, the stock exchange in Lagos. Good morning. It's good to have you on the program. Welcome.
Thank you. Thank you, boss. Thank you.
Uche, it's good to have you here. You can hear me?
Yeah, I can hear you clearly. I can hear you clearly.
Great. Thank you so much for coming through on the program. So let's try to read the current tea leaves very correctly with the fiscal, monetary, economic news and information from the just concluded World Bank IMF spring meetings. In summary, what are your takeaways from everything that the World Bank and the IMF officials and others were saying about the state of the global economy and the marketplace?
The IMF has come out with its report, its World Economic Outlook report, to highlight its worry in terms of global headwind risk as regards to growth. This is the third time the IMF will be looking to regress its forecast for the global growth. This is the third time in the last 6 months. So right now, the IMF is looking at the 3.3 growth year on year for 2019, and that actually signified significant worry as regards to the growth situation from global economies from the point of perspective of the IMF.
Uchenna, just to take it a little bit slow and get everyone to understand it, when the World Bank or the IMF revises global economic outlook 3 times within 6 months, that is within a space of 2 months, they have to revise their projections for the global economic outlook. How serious is this? Is this a warning signal to everyone that something is seriously wrong when you revise your growth outlook twice in just 6 months?
Yes, it's coming from a place of significant worry as regards to the IMF, highlighting the downside risk. The Eurozone in itself, 3 top economies in the Eurozone, Italy, France, and Germany, have put up manufacturing data that have never been that low since the last 5 years. And it's also looking at the Chinese-U.S. trade deal as a significant headwind risk as regards to downside pressure in the global economies. So as time is wearing out, the IMF is continually seeing how this downside pressure is looking to accumulate going forward within the year.
Okay, so if we take this as warnings on global economic slowdown, so what does that mean if you try to isolate the big boy, the big elephant in the room, which is the United States?
Right. So for the United States, the Federal Reserve has also come out to change its policy outlook. The Federal Reserve used to be very hawkish. They were one of the central banks that started normalization in terms of its monetary policy stance, but they look to change their monetary policy stance from hawkish to dovish, and now very, very over-dovish. Now they are also looking at a global headwind risk. The U.S. on its own in isolation is still doing okay, but if you consider the global outlook and the dependence of other economies on the U.S., you know at some point those slowdown in growth risk would eventually be rippled into the U.S. So every significant central bank, as it is right now, have been very conservative and been worrying in terms of how they see the global outlook, as it were.
Yeah, so the U.S. is going dovish, says, well, we're not cutting rates, we're not raising rates in 2019. But what happens if the Fed, Jerome Powell, wakes up in 2020 and says, look, we've got to go back and start pushing rates?
First, I can assure you, first person that will not be comfortable with that will be Donald Trump. He has come out to say significantly that the U.S. should be far, far faster in terms of its growth perspectives if the Federal Reserve have not even looked to normalize in any way whatsoever. So if we have a hawkish or the hawkish Federal Reserve, that does not really look so well on the emerging economies if you look at it, because right now the growth differential between the U.S. and the rest of the world is quite massive, and that's why we can possibly expect a serious flight for safety if this recessionary risk gets to evolve into something quite significant. So if the Federal Reserve would eventually look to hike its interest or change its monetary policy stance to hawkish, that might not in medium to long term look so good on emerging economies, given we'll have a ripple effect in the strength of the US dollar.
Yeah, so trying to stir the world economy and financial system away from these hard rock plays just ahead, the burdens now falling on fiscal policy makers and monetary policy authorities, the central banks, to try and save the world in a manner of speaking. So how much challenges do they have with these emerging risks and moving forward? How much work do you think is there for them to do to try and make sure that we avoid this recession, global economic recession that's been forecast?
Right. So the worry now, one of the very paramount worry now is that a lot of central banks, a lot of global central banks are already have stretched their monetary policy in fighting to as regards to recessionary risk. They are already at the very low interest rates. Some of them are actually in negative zone rates. Some of them are actually in zero rates. And we have that worry that if push comes to shove, well, let's say we have recessionary risk materializing, they might have significant issue with combating this risk. And that's really the worry. Unconventional monetary policy, however, can be dished out to combat this risk. But we also worry that if after the global financial crisis, we're still getting to those points where you don't have significant tools to fight this recessionary risk. That might still not be able to cause significant relief in market participants as regards to their investing settlements. So we might be looking at a very intensified recessionary risk if this gets to materialize going forward. We feel the central bankers, their hands are extremely tied in this case.
Yeah, but what they got to do something, Uchenna. If we take this to the marketplace, if you look at the space at which emerging markets and frontier markets, in particular sub-Saharan Africa, approaching the Eurobond, the global debt market, the DCM for Eurobond offerings. So everyone's rushing there. Nigeria will soon be heading there, both sovereigns and corporates, as it were. So borrowing at a very an appetite that we've seen at a record high in recent years because the rates are relatively cheap, so to speak. But the World Bank and the IMF are saying, hold on a second, folks, you need to be very careful here. Well, there's free money, but again, what if things turn around and you have to pay higher for this debt that you're gobbling up at the moment?
Yeah, and that's why it's actually worrisome that irrespective of the pace of the growth of the U.S. economy compared to the rest of the world, the central bank, the Federal Reserve, need to actually combat its pace so it doesn't move too fast away from the emerging economy. Almost everybody have their significant debt in the U.S. dollar. So imagine, as you have put it out there, we incur some debt as regards to with U.S. dollar, and at the time of payment, the valuation is higher than when we acquired the debt. So it comes to the point where the Federal Reserve needs to still cap its growth as regards to the rest of the economy, so that we don't have significant, should I say, expansionary differentiation between these two economies, the U.S. and the rest of the world.
So what are you folks hearing? Those of you on Market Street, what are you hearing from international investors in whatever asset class or portfolio they're investing in, from debt instruments to equities or ETS, whatever, IFX currencies as well, about where are there opportunities if you look at frontier markets like Nigeria and all that? What's the story out there?
Yeah, so currently, right now, in the short term, we have significant risk on sentiment. If you check the risky asset U.S. equities from the December plunge, you will see that we are almost near an all-time high. So investors are really, really happy throwing their money or their investment capital into these high-yielding assets. However, we have also seen that the rally, as it were, is not being backed up by significant volume of trading. So we are looking at most of this rally would have most likely been due to share buybacks, given the task force fiscal policy that Donald Trump put out there for corporations to repatriate significant funds. So what we are seeing, what has been pushing markets are, wouldn't really say organic buying sentiment. However, we have seen these corporations taking their money back and putting it back into their shares. So you're seeing that, and you were seeing all-time highs getting to move, or getting equities to move at that pace that is really, really significant. So currently right now, on a short-term basis, you have investors going into riskier assets. We also can compare that to oil prices too, as we've seen oil prices soar significantly from the December plunge also, based on risk-on sentiment. So you're still having that investors' relief as everything is beautiful, everything is nice, and they're all going in and trying to take advantage of the market rally. However, we are still worrisome that in the medium term to longer term effect, there is a significant slowdown, and people should be conscious with their investments.
Yeah, I am worried on the equity side of things, where you find significant valuation that should be in favor of our market, but investors are not really picking up the stock. So if these equities are good enough, if they're going to make you smile, why do the equities make you cry sometimes?
Well, sorry, can you go back? I did get the last
let me recap that. What I'm trying to say is that, yes, we have significant valuation opportunities for Nigerian stocks, but almost on a daily basis, it looks like the market is weak. So if it's so cheap and attractive in terms of valuation, why are investors not picking it all up and just grab it all up?
So if you compare our markets to advanced economies, developed markets, the yield differential is quite enormous. So for example, let's be practical here. I would rather put my investment capital in a Dow Jones 30, for example, compared to any chosen equity of my taking in the Nigerian capital market, because I understand that comparing to a similar tenure, similar duration, I would have more yield on my investment if I have them all tied down in an emerging market space. And also we still have our local should I say headwind risk, as our reliance on oil prices is also a significant factor where investors need to look in and understand how things are going, because irrespective of how well oil has been doing since the beginning of the year, there is also the downside risk where global demand might look to push prices downwards. We're also looking at U.S. shale looking to increase its production by another 1.2 million barrels, and those risks are kind of putting investors in that back foot or trying to be cautious, and they would like to play in a space that they feel quite comfortable with. So an average investor would look at these two economies and try to take advantage of the most viable and most profitable, as it were.
Yeah, okay. Thank you so much. It's been a very interesting conversation. A final one. What's your outlook on the market for the rest of the quarter, as it were? Do you think we'll see any significant changes? Earnings are coming through on the equities. We're just getting Zenith Bank now reporting profit after tax of 50.23 billion naira for the first 3 months of this year. That's adding to what Access Bank reported yesterday, which is also around the same level. Earnings per share by Zenith Bank is coming through now. This morning, 160 kobo against 150 naira, or 150 kobo earnings per share reported in the first 3 months of last year. So, two of Nigeria's largest banks are now reporting their first quarter numbers within less than 24 hours of each other.
Yeah, so I still have that strong belief that from a general perspective, the investing atmosphere still looks quite comfortable for investors. However, we need to still be wary of the global risk sentiment. If we have significant downside pressure coming from other economies, some like China, for example, investors might look to be very cautious or safe with their investment, and probably due to that trying to take advantage or mediate between what they look to get in the market. You might see investors move their investment portfolio to fixed income securities just to be safe, at the same time take advantage of the possible upside potential in the emerging market space. So there is still that year in, year out type of sentiment for us as regards to the equity space in Nigeria.
Okay, thank you so much, Uchenna Minis, Chief Market Strategist and Analyst at Eagle Global Markets. Thank you very much. Have a great day. We appreciate your being here, trying to put some of these global issues in perspective for us. Thank you so much. Live to us from our studios at the Nigerian Stock Exchange. This is Zenith Bank, Nigeria's one of Nigeria's tier 1 listed lender, reporting this morning, just as we're starting today's business and markets day, profit before tax from Zenith Bank, 57.2 billion naira for the group. That's much better by 54 billion naira reported in the first 3 months of last year. The bank is also reporting a net profit of 50.2 billion naira for the first 3 months of 2019 from 47 billion naira reported as a group in the first 3 months of last year. Earnings per share, as you have heard earlier, 1 naira 60 kobo, basic earnings per share for the group, and that's better than 1 naira 50 kobo earnings per share, basic earnings per share, EPS reported in the first quarter of last year. Impairments for loans and advances also came in far much better than first quarter of 2018. Zenith Bank reporting 1.28 billion naira against 4.57 billion reported in the first quarter of last year. These are some of the headline figures in terms from this particular bank. Zenith Bank, Zenith Bank is also reporting deposits that's now 3.5 trillion naira against 3.396 trillion naira reported in the first quarter of last year. We'll talk more about this. Let's take a break. We'll be right back in 2.